Well, there's been a lot of talk lately about gold, silver, Iran, China, the dollar, and whether this latest move is the beginning of something much bigger or just another loud headline week. So, in this video, we're going to separate the short-term noise from the long-term signal, and you're going to walk away feeling a lot clearer and a lot more confident about what may actually matter here. Today is Thursday, April 9th in New York, and tell me in the comments what day and date you're watching from. And also, if you value the way I break this stuff down, support the channel by subscribing and commenting John A.G. Best. I'd really appreciate it. Much appreciated. Because if you've been watching this market closely, you already know the surface level story. There was a truce headline. Metals jumped. The dollar got hit. Oil swung hard. Everybody rushed to explain the move in one sentence. And on the surface, that all sounds neat and tidy. It sounds like, okay, ceasefire headline comes out, traders breathe, silver pops, gold pops, end of story. Except that is not really the story. That is just the latest trigger. And to see why, let's start with what actually happened. Gold moved back toward the upper 4,000 range this week, with spot prices sitting in the low 4,700s on Thursday, while silver bounced sharply after the truce headlines and the dollar index hovered right around the 99 area. At nearly the same time, oil got slammed on the idea that energy flows could normalize, only for markets to start second-guessing whether this ceasefire is solid enough to trust. That part is not opinion. That's how the market has been trading these last couple of sessions. So yes, the move was real, the reaction was real, the weakness in the dollar was real. But here's where I want to slow down, because this is where people get themselves in trouble. They see one geopolitical headline, they see metals jump, and then they act like the whole thesis lives or dies on that one event. I don't think that's the right way to look at it. The better way to look at it is this. The truce matters. Of course it matters. Oil matters. Of course oil matters. Shipping routes matter. Regional risk matters. But those things are accelerants. They are not the engine. They can make a move happen faster. They can shake weak hands out. They can create violent swings from one day to the next. But the bigger engine sitting underneath all of this is still currency dilution, debt expansion, sticky inflation pressure, and the simple fact that hard assets do not get created with a keyboard. That's the big picture. That's the piece people keep dancing around. Now, when I say the truce is not the whole story, I'm not saying ignore it. I'm saying be realistic about it. Because from recent market updates, the ceasefire is being treated as fragile, not final. You still have cross-currents in the region. You still have questions around enforcement, around shipping, around what happens if either side decides the current arrangement is not serving them anymore. Even after the initial relief trade, the market did not settle into some calm, permanent, everything is fixed mood. It stayed jumpy, and that tells you something. And that matters because fragile peace can still create inflationary residue. People hear the word ceasefire and assume that means the inflation scare is over. I don't think that follows. Damage to supply chains does not disappear overnight. Risk premiums do not disappear overnight. Insurance costs do not disappear overnight. Energy systems do not go from stressed to normal just because a headline says progress. Even recent energy commentary made the point that war-related disruptions can leave scars even after a temporary halt in fighting. That is exactly the kind of thing people forget when they reduce everything to one candle on a chart. And by the way, this is where I want to challenge one of the lazy conclusions floating around. Some people are acting like if the ceasefire holds, that's automatically bearish for metals, and if it breaks, that's automatically bullish for metals. I think that's way too simplistic. A temporary de-escalation can help metals if it weakens the dollar and revives risk appetite. A renewed flare-up can help metals if it reignites fear and inflation expectations. In other words, there are multiple paths here. That's why trying to trade this only through a headline lens is dangerous. What matters more is what the headline does to expectations around inflation, rates, liquidity, and confidence in paper money. And on that front, I do not think the market is out of the woods at all. Because while people have been obsessing over every development in the Middle East, the underlying U.S. backdrop has not magically improved. Total public debt has already crossed the 39 trillion mark. That is not some estimate from a random comment section. That is right there in the official data. And once debt gets that large, the system starts feeding on itself. More debt means more interest expense. More interest expense worsens the fiscal picture. A worse fiscal picture usually means more borrowing, more pressure, more monetization risk, more long-term erosion in purchasing power. That loop is the story. That is why I keep coming back to the dollar. Because people say inflation, people say currency debasement, people say cost pressures, people say living expenses, people say groceries and gas and rent and insurance, and they think they're talking about different things. They're not, really. They are all different faces of the same problem. If your currency buys less over time, that is the issue. If your savings need more nominal dollars to buy the same real-world stuff, that is the issue. And gold and silver, over very long periods, tend to react to that reality. Now, does that mean metals go straight up in a perfect line? No. Of course not, they never do. You get pullbacks, you get air pockets, you get liquidation phases, you get people who panic on down days and become prophets on up days. That is the market. But the long-run pressure does not go away because traders had one relief rally after a ceasefire headline. In fact, some of the freshest information coming into this week points the other way. The next U.S. inflation release is due Friday morning, and markets have been laser-focused on it specifically because policymakers know energy shocks do not always pass through instantly. Recent policymaker commentary has been pretty clear that higher energy prices can work through the economy slowly, not all at once. That means even if the first panic in oil cools off, the ripple effects can still show up later in broader prices and consumer behavior. And that brings me to the economy, because this is where it gets tricky. I do not think the economy looks healthy enough to laugh off all of this, but I also don't think it's collapsing in the dramatic way some people keep predicting every week. The most recent U.S. jobs report showed payrolls rising in March, but the official summary also said employment had changed little on net over the prior year. So this is not some roaring economy with zero problems, and it's not a sudden crash either. It's more like a system losing momentum while price pressures still refuse to behave. And that kind of environment is exactly why so many people keep coming back to metals. That mix matters: slower momentum, persistent inflation risk, heavy debt, uncertain policy path, fragile geopolitics. That is not the kind of backdrop where I want to be overly impressed by paper promises. And there is another layer here that I think deserves more attention, because it helps explain why this story keeps coming back even when metals cool off for a while. The dollar can still catch a short-term bid during stress. We all know that. It happens. But longer-term confidence is a different question entirely. Recent tracking on reserve trends and currency performance shows the dollar still dominates globally, yet its share of reserves has been gradually slipping over the years, while gold's role in official portfolios has become more important again. So when people frame this as either the dollar is instantly dead or the dollar is totally untouchable, I think both takes miss the nuance. The real issue is not disappearance. The real issue is erosion, and erosion is enough. Because a reserve currency does not need to collapse in one dramatic weekend to create a huge move in hard assets. It just needs to lose a little credibility at a time while governments keep issuing more promises than they can comfortably fund. If the global system starts asking harder questions about future purchasing power, about fiscal discipline, about reserve diversification, about the cost of financing endless deficits, that alone can support a stronger long-run bid for gold. Silver then rides alongside that process, though usually with more volatility and less patience from the crowd. And speaking of patience, this is one reason I think people need to stop treating every pullback in metals like some devastating verdict on the thesis. March was rough for gold. In fact, market commentary this week described it as the weakest month in a very long time, driven more by deleveraging and liquidity pressure than by some clean rejection of the long-term fundamentals. That distinction matters. Liquidation can hit even the strongest themes when people need cash, when positioning gets crowded, or when macro expectations swing too fast. A bad month does not automatically mean a bad cycle. Sometimes it just means the market had to wash itself out. And honestly, silver investors should already understand that better than almost anybody. Silver almost never moves in a polite, tidy, linear fashion. It often looks broken, right before it looks powerful again. That is part of its personality. So when I hear someone say, well, silver dropped before, so the whole idea is finished, I usually hear somebody telling me more about their time horizon than about the market itself. The other reason I think the silver story deserves serious attention is that it sits in this interesting space between monetary demand and real-world usage. Gold can rise mainly because trust is falling. Silver can rise because trust is falling and because actual fabrication demand still matters. That creates a market with more moving parts, which is frustrating sometimes, yes, but it also creates more ways for pressure to build under the surface. You do not need every variable to lean bullish at the same moment. You just need enough of them leaning that way for long enough. And recently, the overall backdrop has been doing exactly that. You have official sector gold demand staying alive. You have macro uncertainty staying alive. You have questions around growth staying alive. You have questions around inflation staying alive. You have the futures market staying jumpy enough that margin requirements had to be adjusted more than once earlier in the year. I also think people underestimate how much narrative whiplash can feed the silver move once it starts. Silver does not need universal agreement. It just needs enough people to go from dismissing it to reconsidering it. That's the shift that matters. The first phase is usually ridicule or neglect. The second phase is curiosity. The third phase is urgency. Most people do not recognize phase 2 while they are living through it because it feels too messy, it feels too uncertain, it feels too early. Then suddenly phase 3 arrives and everybody acts like the signals came out of nowhere. They didn't. They were just inconvenient to look at when prices were still volatile. And since we're talking about inconvenient facts, let me add one more. Even with the relief trade after the truce, markets are still acting like policymakers have a problem on their hands. Recent minutes coverage and official commentary did not sound like people who think inflation is comfortably defeated. It sounded like people who know energy, geopolitics, and growth are pulling in opposite directions, and that any policy mistake could make things worse. That kind of uncertainty usually ends up helping the case for holding at least some exposure outside the conventional financial system. So no, I'm not saying every road leads straight to the same outcome on the same timeline. I am saying the range of plausible outcomes still argues for taking hard assets seriously, and in that range, silver remains the market that can go from ignored to impossible to ignore, much faster than most people expect. And when I say paper, I mean that in more than one way. I mean fiat currency, yes, but I also mean the paper market in silver, because one of the things that keeps standing out to me is how fast perception can change when people stop caring about synthetic exposure and start caring about actual access. And I want to be careful here, because I'm not going to sit here and tell you every strange spread or every unusual relationship in the futures curve proves some immediate breakdown. I don't think that's responsible. But I do think the silver market has a fragility to it that people underestimate. Why? Because physical demand does not have to become infinite to create stress. It just has to outrun convenience. That's it. If enough people decide they want the real thing instead of the symbol on a screen, things tighten fast. Not eventually. Fast. And that's even more true now than it was years ago because buying behavior has changed. In the old world, a rush into metals meant people lining up outside shops. In the current world, it means clicks. It means phones. It means dealer inventories getting chewed through online before the average person even realizes what's happening. The speed of information has changed. The speed of ordering has changed. The speed of fear has changed. That's why I never dismiss retail demand waves as some cute side story. They matter. And when people say, well, most people still don't own any meaningful amount of gold or silver, I actually think that supports the long-term case rather than weakens it. Because if ownership is still relatively limited, then the market has not yet felt what broad public participation really looks like. The crowd is not early just because you and I are already paying attention. The crowd is early when your neighbor starts noticing the purchasing power problem and decides their cash is not enough protection anymore. That's when things can get wild. And here's the thing. People usually do not wake up because of a white paper. They wake up because life gets more expensive in a way they can't ignore. They wake up when the bill that used to annoy them now scares them. They wake up when the weekly shopping run feels different. They wake up when one more fill-up at the pump forces a real conversation at the kitchen table. That is how macro becomes personal. And once macro becomes personal, the precious metals thesis stops sounding abstract. It becomes practical. Now, let me pivot to China for a second, because this is another piece of the puzzle that I do not want people to gloss over. According to the latest publicly available reserve updates, China's central bank added gold again in March, extending its buying streak to 17 straight months and bringing official holdings to a little over 74 million fine ounces. That is not a rumor. That is one of the cleanest signals in the whole story. And what makes it especially interesting is that the value of those holdings fell with price, even while the physical ounces kept rising. In other words, they kept adding through weakness. That matters a lot. Because central bank buying does not guarantee a straight-line rally tomorrow morning. But it does tell you something about how serious institutions view gold's role in reserve management under a more uncertain global order. And from the broader reserve conversation, we also know that the dollar's dominant role has been gradually eroding over time, even if it remains the biggest player by far. So no, I'm not here to tell you the dollar vanishes. That's fantasy. But I am saying the incentive to diversify away from overdependence on one currency is very real, and gold sits right in the middle of that conversation. Silver benefits from that environment too, though in a different way. Gold tends to get the official sector respect first. Silver tends to get rediscovered later, often when people realize they want exposure to the same broad thesis but with a market that can move harder and faster. That is usually when the gold to silver conversation comes back in a big way. And I've noticed more people starting to pay attention to that relationship again. Now, I'm not going to throw a pile of exact ratio numbers at you back to back, because that's not actually how most people think about it in real life. Here's the simple version. When silver starts gaining on gold, that usually means confidence is broadening inside the metals trade. Gold is the cautious first move. Silver is the louder second move. Gold is where people hide first. Silver is where they reach when conviction gets stronger. That doesn't mean silver has to outperform every week. It doesn't. But when it starts to, people notice. And the reason I'm bringing that up now is because one of the more interesting developments lately has been the weird behavior around spot and futures pricing. Normally, you expect a cleaner structure. You expect time, storage, financing, all of that to create a more recognizable relationship. But lately, the market has looked less normal, not necessarily broken, not necessarily screaming collapse, just off. Too balanced in some moments, too awkward in others, like the market is trying to decide whether near-term metal should carry more urgency than it used to. I think that's worth watching. Not panicking over, watching. Because strange market structure can mean a lot of things. It can mean tightness, it can mean hedging pressure, it can mean positioning, it can mean temporary dislocation, it can mean confusion. And this is another place where I want to push back against exaggeration. Weird spreads do not automatically equal imminent failure, but they also should not be shrugged off as meaningless if they keep showing up. When a market starts behaving differently for weeks instead of hours, I pay attention. And silver has been giving that kind of vibe. You see it in the conversation around inventories. You see it in the focus on warehouse stocks. You see it in how quickly retail availability can feel thinner when enthusiasm picks up. You even see it in the way exchange operators had to raise margin requirements earlier this year when volatility got out of hand. That tells you the paper side of the market is not some sleepy backwater. It's highly leveraged, highly emotional, and very capable of swinging from complacency to chaos. That does not mean the physical market disappears tomorrow. It means don't confuse still functioning with invincible. There's a difference. And since we're talking about narrative traps, let me point out another one. There is a habit in this space where every bullish silver argument eventually turns into, therefore the paper market is going to implode next week. I do not think you need that leap. Honestly, I think that leap weakens the case. You do not need a dramatic Hollywood ending to make a strong silver argument. Debt expansion is enough. Currency dilution is enough. Investment demand is enough. Industrial demand is enough. Growing awareness is enough. Central bank gold accumulation is enough to reinforce the broader hard asset story. You do not need to force every observation into an immediate apocalypse. Sometimes the most powerful trend is the slow one. Sometimes the market reprices because confidence erodes one layer at a time, not because one switch flips. And if that is what we are in, then patience matters a lot more than theatrics. Now let's go back to oil for a second, because I think people misunderstand why that move mattered. Yes, the initial plunge in oil after the truce headline was dramatic. It was one of those moves that makes people feel like the whole inflation scare was overdone. But if you zoom out even a little bit, the lesson is not problem solved. The lesson is the system is extremely sensitive. A market does not drop that hard, that fast, unless traders were carrying a major fear premium into the event. And once you know the fear premium was there, you also know it can come back. That's the key. So when I hear people say oil crashed, therefore inflation is dead, I think that's too cute by half. We already have central bankers warning that energy moves work through the economy over time. We already have markets openly debating how much inflation data will stay sticky. We already have a fiscal setup that keeps long-run purchasing power concerns alive. One violent move in oil does not erase all of that. And if you're successful, share your success story in the comments so others can stay motivated. Because a lot of people here are not trying to become heroes. They're just trying to protect progress. They're trying not to lose in real terms while the rules keep changing around them. And I think that's a very reasonable goal. That's also why I do not like reducing gold and silver to pure speculation. Yes, traders speculate. Yes, momentum exists. Yes, narratives go too far sometimes. All true. But for a lot of regular people, metals are not really about getting rich overnight. They're about creating one more layer of protection in a world where the official answers keep sounding thinner. And to me, that is the part that has only become more relevant, especially now. Because if you step back and line up the pieces, the picture is pretty striking. You have a ceasefire that the market itself still treats as brittle. You have a dollar that just got reminded it can fall quickly when geopolitical assumptions change. You have oil proving how unstable the pricing environment still is. You have debt sitting at a level that would have sounded absurd not that long ago. You have inflation data still front and center. You have a labor market that is not collapsing, but is not exactly roaring either. You have China continuing to add gold. And you have a silver market that still looks more delicate than many people want to admit. That is a lot. And none of those pieces by itself has to carry the whole thesis. That's what makes the setup so interesting. You don't need any single pillar to do all the work. The story is distributed. It's in the macro. It's in the currency. It's in the reserve behavior. It's in the geopolitical backdrop. It's in the structure of the silver market. It's in the psychology of late adopters. All of that matters. So where does that leave us? In my opinion, it leaves us in a period where gold and silver can stay volatile in the short run and still remain deeply compelling in the long run. Those two things are not opposites. In fact, they usually travel together. Strong secular moves often look messy while they're happening. They do not announce themselves with perfect clarity. They create doubt. They force people to think. They punish overconfidence on both sides. That's why I'm not interested in pretending this is easy. I'm also not interested in pretending the answer is to stare at every intraday candle and rewrite the entire thesis every 6 hours. That is how people get emotionally shredded. If your whole worldview changes every time the dollar bounces, every time oil swings, every time one spokesperson says progress and another says violation, you are going to exhaust yourself. The better question is whether the foundational pressures are easing in a meaningful way. And I don't think they are. Could we get calmer headlines for a stretch? Sure. Could metals consolidate? Absolutely. Could silver cool off after a sharp bounce? Of course. That's normal. But if you ask me whether the debt burden is suddenly fixed, no. If you ask me whether currency dilution has stopped mattering, no. If you ask me whether central banks have lost interest in gold, clearly no. If you ask me whether silver's physical side has become robust enough to ignore demand waves, I would also say no. That's why my broader view stays constructive. Not because I think every headline is bullish. Not because I think every weird spread confirms the moonshot tomorrow. Not because I think every ceasefire will hold or every truce will fail, but because the deeper forces underneath the market still point the same way. And there's one more thing I want to say before I wrap this up. A lot of people in this space want certainty. They want a neat answer. They want someone to say, this exact event means this exact price by this exact date. I can't give you that, and honestly, nobody credible can. Markets don't owe us that kind of precision. What we can do is read the direction of pressure. We can look at how systems behave under stress. We can notice when official actors are buying one thing and printing another. We can notice when debt compounds faster than confidence. We can notice when a market like silver starts acting like it has less slack than people assumed. That is useful, and that's enough to build a framework around. So my bottom line is pretty simple. The truce may reduce one layer of immediate panic, but it does not erase the reasons people own gold and silver in the first place. If anything, the past few sessions have shown just how fast the macro landscape can change and how dependent markets still are on fragile assumptions. That is not a bad environment for hard assets. That is the kind of environment that keeps bringing them back into focus. And if you've been losing sight of the bigger thesis because the day-to-day action has been loud, bring it back to first principles. Scarcity matters, credibility matters, debt matters, purchasing power matters, human behavior matters. And when enough of those pressures start leaning in the same direction, price eventually responds. Maybe not on your schedule, maybe not in a straight line, but it responds. That's how I see it right now. That's why I think the next move in silver could matter a lot more than people realize. And that's why I would spend less time obsessing over whether one headline solved everything and more time asking whether the underlying system has actually become healthier. Because I don't think it has. I think it's still stretched. I think it's still fragile. And I think gold and silver still belong in that conversation in a very serious way. As always, take this as one guy's read on the market for educational purposes only, not personal financial advice. Do your own homework, think for yourself, and make decisions that fit your risk tolerance, your timeline, and your real life.